There is a buyer in the gold market right now who never checks the price before deciding to buy. This buyer does not care what happened in the last session, does not care about the headlines, does not flinch when the screen turns red. And this buyer is the biggest force in the entire market. If you own gold or you are thinking about it and every pullback makes your stomach drop, I need you to understand who is standing underneath this market, catching every dip. Because once you see it, the fear you feel on the down days starts to look like exactly what somebody wants you to feel. Here is the thing the financial channels will not sit you down and explain, and it matters directly to your retirement. The people who profit from your nervousness need you to believe gold is a wild, speculative thing that could fall out from under you at any moment. That story sells. It keeps you trading, it keeps you scared, it keeps you buying and selling on their terms. But there is a floor under this market that most retirees have never had explained to them. And by the end of this, I want you to understand exactly what that floor is made of, why it is stronger than it has ever been in your lifetime, and what it means for the money you are trying to protect. So let me give you the first piece right now, because I do not believe in making you wait for something real. The central banks of the world, the national banks that manage the reserves of entire countries, have been buying gold at a pace we have not seen in modern memory. For 3 straight years now, this group has bought more than 1,000 tons of gold a year. To put that in plain terms, that is roughly double what they were buying on average across the whole prior decade. They did not do it quietly one year and stop. They did it, and then they did it again, and then they did it a third time. That is not a trade. That is a policy. Now, think about what that actually means for you as somebody holding gold or thinking about holding it. When a hedge fund buys gold, it can sell it next week if the chart looks ugly. When a nervous individual buys gold, he might dump it the first time it drops and he gets scared. But when the central bank of a nation buys gold, it is not planning to sell it into next month's pullback. That gold goes into a vault as a reserve asset, and it tends to stay there. So every one of those thousands of tons is metal taken off the table, bought by a holder who is not going to panic and hand it back. That is the difference between a price that floats on sentiment and a price that has a floor built under it. And this is the part one really want you to sit with, because it is the whole thesis of what I am telling you today. A record central bank bid is the floor under every dip. When gold sells off, and it will sell off from time to time, because nothing in this world goes straight up, there is now a class of buyer standing there with a nearly bottomless appetite and no reason to care about the short-term chart. They are not buying gold to flip it. They are buying it because they have decided at the level of national policy that they want to hold more of it and less of something else. Every dip is, to them, a discount. And a discount to the most price-insensitive buyer on earth is exactly what a floor is. Let me tell you why they started doing this, because it is not a mystery and it is not a conspiracy. A few years ago, the world watched something that shook every central banker awake. A major power had a large share of its foreign reserves frozen by other countries, essentially overnight. Now, whatever you think about the politics of that, and I am not here to argue the politics, set that aside. Put yourself in the shoes of every other country's central bank watching it happen. The lesson they took was simple and permanent. Reserves you hold in another country's currency, sitting in another country's financial system, can be switched off by that country. But gold sitting in your own vault, inside your own borders, cannot be frozen by anybody. It is the one reserve asset that is nobody else's promise. And so the buying accelerated, and it has not stopped. There is a milestone here that tells you how serious this shift has become, and almost nobody in the mainstream financial press framed it for you the way I am about to. Gold has quietly climbed past the euro to become the second largest reserve asset held by the world's central banks, sitting behind only the US dollar. Think about that. Of all the ways the most sophisticated financial institutions on the planet can hold their national savings, gold is now number 2. Not a tech stock, not a bond, a metal that has been money for 5,000 years. That did not happen by accident, and it did not happen because the price was going up. It happened because the people who manage trillions decided, deliberately, that they needed more of it. That is the smart money voting with its vault, and it is voting the same way 3 years running. Now let me speak to you directly for a moment, because this is exactly the point where what I am describing stops being a market story and becomes a decision you personally get to make. If you have $100,000 or more sitting in a 401k or an IRA, here is something most people your age have never had explained to them, and Wall Street is in no hurry to explain it, because it does not earn them a fee. The same central banks I have been describing are moving into physical gold at a record pace to protect their reserves. And there is a perfectly legal, IRS-recognized way for an ordinary American to do a version of the very same thing inside the retirement account you already have, without taxes and without penalties. It is called a self-directed precious metals IRA, and it lets you move a portion of your retirement savings into real, physical gold and silver that you own. This is not some exotic club for insiders. If you have got that 100,000 or more in any retirement account, this is available to you. I put together a free guide that walks through exactly how it works, step by step, in plain English. If you are watching this on your TV, you can just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It is free, there is no obligation, and it will show you how retirees are quietly doing what the central banks are doing. Now let me get right back to it, because the floor story goes deeper. Here is a piece of evidence that will change how you read every headline about gold from now on. For most of the modern era, there was an iron rule that traders lived by. When real interest rates went up, gold went down. The logic was simple. Gold pays you no interest, so when bonds start paying a fat real return, money leaves gold for bonds, and the gold price sags. That relationship held for decades. It was as close to a law as this market had. And recently, that law broke. Gold has climbed even while real yields stayed high, which under the old rules should have crushed it. The old inverse relationship simply stopped working. And when a decades-old market law breaks, that is not noise. That is a signal that a new and more powerful force has entered the market. That force is the central bank bid and the physical demand behind it, buying for reasons that have nothing to do with this month's yield. I want to be the honest voice here, because the financial channels will not be. There is a real history of central banks getting gold exactly wrong, and I am not going to hide it from you. Go back a couple of decades, and you will find the United Kingdom announcing it would sell off roughly half its national gold reserves, telegraphing it to the whole market before the sales, and doing it right at the bottom of a long bear market. They marked the low. They sold the family silver, so to speak, at the worst possible moment, and gold went on to multiply many times over in the years after. So central banks are not gods. They can be late, they can be wrong, they can sell at the bottom. But notice which direction they are moving now. For the first time in a very long time, the official sector as a whole is not selling into weakness. It is buying aggressively year after year. When the group that once sold at the bottom becomes a determined buyer, that is a change worth paying attention to. Let me pull back and put this in the longer sweep of history, because the pattern rhymes. Gold has lived through decrees and reversals that most people have completely forgotten. There was a time when an American president signed an order making it illegal for ordinary citizens to own gold, and the government then revalued the price of gold upward by decree, close to 70%, overnight, by the stroke of a pen. There was a time decades ago when a group of powerful nations pooled their reserves to hold gold at a fixed price, spending their metal to defend that line, until one day they simply gave up and let it go. The lesson across all of it is the same. Governments and their banks have spent a century trying to manage, suppress, fix, and control the price of gold, and every single time, the metal eventually won and went where the fundamentals sent it. What is different today is that the official sector has stopped fighting the tide and started riding it. That is new. That is the floor. Here is the part that almost nobody gets to, and it is the middle of this story where it really changes. You might be thinking, all right, the central banks are buying, but what happens the day they slow down? Fair question. Let me show you what a slowdown looks like, because history already gave us a preview. A little over a decade ago, the Federal Reserve merely hinted, not acted, just hinted, that it might slow the pace of its bond buying. It was a whisper, not a policy change, and gold fell hard that year, down roughly 28%, simply on the fear of a buyer stepping back. Now, hold that thought against today. Back then, the mere hint of one buyer slowing down knocked gold down almost 30%. Today, you have a whole category of buyer, the central banks of the world, buying at double their old pace, for reasons rooted in national security rather than in a chart. The buyer that scared everyone by whispering has been replaced, in importance, by a buyer that is not whispering, is not trading, and is not going anywhere. That is why this floor is different from any floor gold has stood on before. And let me be clear-eyed with you, because you deserve it. I am not telling you the central banks will buy exactly the same amount every single year forever. The pace can slow. Some years the number will be higher, some years lower. What matters is not the exact tonnage in any one year. What matters is the direction, And the reason is structural. It is about not wanting your national savings to be freezable by a rival. It is about not trusting that the old arrangements will hold. Those reasons do not evaporate because gold had a bad month. So even in a year where the buying cools, the motive underneath it is intact. And that motive is what puts the bid back in on the next dip. The floor is not a promise that gold cannot fall. It is a reason that gold keeps getting bought when it does. Now think about who is on the other side of this and why they do not want you to understand what I just explained. The trading desks and the big banks make their money on your churn. They profit when you are frightened into selling into a dip and then coaxed into buying back higher. A calm, informed retiree who understands that the world's central banks are standing under this market, catching every dip. That retiree is a terrible customer. He does not panic sell. He does not trade his position away on a scary day. He holds. And a market full of calm holders is a market where the desks make far less money off of fear. So they are not going to run a segment explaining the central bank floor to you. It is not in their interest. It is in mine, because I am not on the other side of your trade. Let me bring this down to earth, to one person, because this is where it becomes real. Picture a man about your age, a saver who did everything right his whole life. He worked, he put money away, he built up a real nest egg. And every time gold pulls back, he sits at his kitchen table and feels that cold drop in his gut, wondering if he made a mistake, wondering if he should sell before it goes lower. That man is not wrong to feel fear. Fear is human. But what he does not know, because nobody told him, is that on the very days his stomach is dropping, there are institutions the size of nations quietly stepping in and buying the metal he is thinking about selling. He is feeling the fear. They are collecting the discount. The only difference between them is information. And information is the one thing I can actually give you. So let me tell you the honest, practical way to think about your own position, because understanding the floor is not the same as being reckless. Own the real thing, not a paper promise that says you own it. A floor built by physical demand only protects you if what you hold is physical. Size your position so that a sharp drop, and there will be sharp drops, can never force you to sell at the wrong time. The whole advantage of standing on the same side as the price-insensitive buyer is that you get to be patient like they are, and you can only be patient if you were never overextended in the first place. And whatever you do not sell into the shakeout. The shakeout is precisely the moment the biggest buyers are waiting for. Do not be the frightened holder handing them their discount. And I have to be square with you about the risk, because anybody who is not is selling you something. Gold can fall, and it can fall hard and stay down longer than feels comfortable. The volatility is real. A record central bank bid is a powerful case for a durable floor under this market. But it is a case, not a guarantee, and nothing I am saying to you is personal financial advice. I do not know your full situation. What I am giving you is the piece the mainstream leaves out, so that when the next scary day comes, you can weigh it with your eyes open instead of just reacting to a red screen and a nervous headline. Now here is the recognition moment I want to leave you with, and it is the whole reason understanding this now matters. Right now, you are early. The central banks already know. They have known for years, and they have been positioning quietly, vault by vault, ton by ton, without a press release, without a headline crawl telling you about it. The pension funds, the mainstream advisors, the financial television, they have not fully caught on yet. They are still telling you gold is a fringe, speculative thing. But by the time it becomes obvious, by the time every advisor is recommending it, and it leads every news segment, the easy part will already be behind us. That is how these things always go. Nobody sends you an invitation. Nobody is going to call you and tell you the moment has arrived. The smart money does not announce itself. It just quietly does the thing, years before the crowd shows up, and the crowd always shows up last and pays the most. You are hearing about the floor while it is still being poured. That is a rare place to stand. So let me answer the question the title asked you, plainly. Are the central banks buying gold faster than ever? Yes, more than 1,000 tons a year, 3 years running, roughly double their old pace, and for reasons that are structural and are not going away. And what that means for you is this. Underneath every dip, every scary headline, every red day the trading desks used to shake you loose, there is now the strongest, most patient, most price-insensitive buyer the gold market has ever had, standing there ready to buy what frightened holders sell. That is the floor, and now you know what it is made of. If you have watched me all the way to here, you are exactly the kind of person this next part is for. For those of you with $100,000 or more in a retirement account, I hold a free, one-on-one educational web conference, no cost and no obligation, where we walk through how this actually works for your specific situation, how retirees are moving a portion of their savings into physical gold and silver inside the accounts they already have. If you would like a spot, just mention that you watched this full video, and let me give you the honest reason to do it now rather than someday. The best time to make a calm, unhurried decision like this is precisely when nothing feels like an emergency, when you have the room to think it through clearly. That window is open right now, while gold is quiet and the crowd has not arrived. Once it feels urgent to everyone, the calm, cheap, reversible moment to decide has already passed. So if you are watching this on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Get the free guide, book the conversation, and let me help you stand where the central banks are already standing, on the floor and not out in the cold with the frightened crowd.